There are, I mean, all the standards are important, and all the standards will have its own implication. But there are 3 or 4 standards which are very critical and which can have a significant impact on the entire accounting, the guidance. So one is actually consolidation, second is business acquisition, third is finance instrument. So these 3 or 4 standards have far-reaching implications, and it completely changes the way we are thinking or the way we used to think earlier. So it's not a so there are no minor changes. The changes are really drastic, and consolidation is one of that. So I think it's a right choice to start with this topic for chamber, and I'll also go slow on this topic because I want you all to be together with me. So if you have any doubt or any discussion, please stop me. We can have that topic or discussion. We can cover at that same time rather than actually waiting at the end. And anyway, finally at the end, we'll have a time slot for Q&A session. But nonetheless, so if you have any query, you are all most welcome to stop me and have the discussion. So now first, what is the background of IND-AS 110? Why this was introduced? Why IFRS 10 was introduced? What was the need for changing the standard? So just take you the background or history to it. Indian GAAP was basically all driven by percentage of holding. So control was defined as composition of board of directors. If you have control on the composition of board of directors, that was one. Or if you had control over majority of the equity. So the way we perceived every time was if you have a holding which is more than 50%, then you have the control. And if you have the control, then you consolidate it. So this was the main concept which we have learned in school, in colleges, and we have implemented this over the years. Now, IFRS had a different, little bit different. So even this was one of the main criteria. But the definition there was if you have a power on operating and financial decision making. Now, during 2008 financial crisis, when the Lehman Brothers and many other incidents came in, that time it was felt that few of the transactions were completely kept out of the books. So the companies had actually control, not by way of a shareholding, but by way of some other power. The power could be exercised by way of an agreement, or powers could have been exercised by a proper structuring, but not by proper holding. So the holding was kept lower than 50%, but because of the way structuring was done, they had the control. But by not consolidating, those loss-making companies or highly leveraged companies were taken completely out of the book. So this was noticed, and there was a need completely felt to have a new definition which covers all the transactions. Just to give you a very raw example and a very small example, suppose there is a holding company, H Limited. Now that holding company had 2 subsidiaries, say S1 and S2, right? Now both are 50%, 50%, right? Always 49%, 49%. And these 2 companies again have another subsidiary company where both S1 and S2 hold 50%, which is say ultimate subsidiary called US. Now in this US, there was no major holding by more than 50% by any of the company. So holding company at parent level was never consolidated. So this was the few of the lacuna if you go just by percentage of holding. So there was a clear need felt at various levels to have definition rather than to move out from percentage holding and to come to the give the actually real life or come to the actually substance rather than mere the form. Now in IFRS there were 2 definitions which were prevailing. One was in Indian IAS, and apart from that there are interpretations issued. So SIC 12 was another definition which was created for special purpose entity. Now when IFRS 10 was introduced, it basically covered both the definition and gave a proper guidance or elaborate guidance to kind of give guidance on all the circumstances. Now what is the definition? What is the change? That we'll all see in coming slides. Now to give you basic background about why this standard is important. So these have far-reaching impacts. So for example, if the company or the holding company would have its own objective to consolidate or not to consolidate, right? If a company wants to show higher revenue number, then it would be keen to consolidate the subsidiary company anyhow. So they would actually try to kind of structure the transaction to consolidate the subsidiary company to show higher revenue number. and higher revenue number probably would be having different reasons, to get loan or to get whatever, from investors' confidence. So those would be the objective. The other objective would be not to consolidate few of the companies, So there, if the subsidiary company has high borrowing, the companies or the management would try to avoid consolidation anyhow. So these are the kind of few things which trigger the structuring and to avoid or to consolidate. So this was the kind of why IFRS 10 definition was changed, and instead of having percentage of holding, it moved completely to other definition of control. Now, consolidation is applicable in all the cases. So if you are having a control on any of the company, consolidation is applicable. Under Indian GAAP previously, consolidation was applicable, but consolidation was applicable only when you had a subsidiary company. So there was a guidance issued by the institute or by SEBI which said consolidation is required only if you have a subsidiary company. And then we had AS 21, then we had AS 23 for associate, AS 27 for joint venture. Now, if you have only associate or a JV without a subsidiary, the company is never used to prepare consolidated account, because one of the major conditions was you need to prepare consolidated accounts only if you have a subsidiary. If you have a subsidiary, if you don't have a subsidiary but a joint venture or an associate, standard 23 and 27 say standard 23 and 27 were applicable only when you are preparing consolidated financial statement. But by itself, AS 23 and AS 27 never forced the companies to prepare consolidated financial statement. So if the company did not have a subsidiary but only a JV or an associate, there was no need to prepare consolidated financial statement. This has gone completely changed under IND-AS. Under IND-AS, even if you don't have a subsidiary, if you have just one associate or if you have a joint venture, even though there is no subsidiary, still you need to prepare consolidated financial statement. So this is a bigger change. The standard itself says consolidation is applicable in all the cases. So even if you have joint venture, even if you have associate, or even if you have a subsidiary. Now there are a few exemptions here. So the exemption is only one, and these are the two conditions. All the conditions are cumulative. All the conditions are different. But what it says is, if the company's shares are not listed, then second condition is it's not going for listing. Then third is there are other minority interest holder or non-controlling interest. The word minority interest has now been changed to non-controlling interest. So whenever I say non-controlling interest, it means minority interest. The non-controlling interest, the owners agree for non-consolidation. So there is an approval from the other party. So if I am controlling entity and the other party has say 40%, I have a 60% share. The other party also agrees that even if you don't prepare consolidated financial statement, it is fine. And the fourth and main critical condition, which is why it has very narrow scope, is that it is applicable only if the ultimate parent company prepares the consolidated financial statement. So think of a structure where there is a holding company on the top, then subsidiary 1, subsidiary 2, subsidiary 3, subsidiary 4, right? All are behind 1 to 1, below 1 to 1. Now if this exemption was not there, then at each level the CFS amounts were mandatory. So holding company will prepare all the consolidated accounts for including S1, S2, S3, S4, S5. S1 again will prepare its own financial statement with S2, S3, S4, S5 and so on. So this would have required a lot of efforts, right? So to do away with this has been an exemption provided all these conditions are satisfied. So if these are wholly owned subsidiary, then the condition of approval from the other shareholder will not apply anyways. But if these are partially owned, then the approval of the other investor is also required. So if the other investor objects that I want consolidated financial statement as S2 level or S3 level, then the company will have no choice but to prepare CFS. So if these conditions are satisfied, then it is fine. The company may not prepare CFS, but otherwise in all other cases, the CFS would be compulsory.
Yeah. So that means that other shareholders, which are other than majority, have to give its attention 100%.
Everyone should agree.
Everyone should agree. Doesn't agree.
Then you will come to
So it's 100%.
Yeah. In fact, in a listed company, so in a listed company, if you have 100% subsidiary, then it will be possible. But if there is a minority interest involved, then it may not be possible if the other people object. you have to go for the consolidated financial statement at that level also. At every stage or at a stage where there is other investor. So in cases it might happen that holding company is one, S1 is 100%, S2 is 100%, but S3 is not, say S3 is only 70% of S2. So at S3 level, then probably the CFS would be required. But S1 and S2 being 100%, the company might go for option of not to prepare consolidated financials. So these are all cumulative. So these are all required. If all the conditions are met, then we can go ahead. If the company is one more thing. So basically, under the Companies Act, there is a similar exemption given, but earlier, so earlier the exemption was only for fully owned company. Now the definition has been changed, and now it is in sync with what is given here under IND-AS. So now both are same. What is another scope exclusion? Another scope exclusion, with the standard itself very clearly says, is on post-employment and retirement benefit. So if you have created a trust, for the employment benefit, or for example gratuity, you have a gratuity trust for the benefit of the employees, or if you have any other trust for like PF, a few of the corporates have its own PF trust, which is for the benefit of the employees. So those are excluded from the scope by the standard itself. So those should not be consolidated because the objective is to give benefit only to the employees. So those are excluded. And the third exemption is consolidation of investment entities. Now, what is investment entity? Investment entity is a company with the objective of investment. So what it does is, it raises money from investors, collects the money from multiple investors, and invest in securities on its own. So for example, the companies like PMS, Portfolio Management Services, right? So they have 1,000 investors, where they collect money from 1,000 investors. They have their own department of research. They acquire companies and they invest for long term, short term, depending upon the market circumstances. Now, in that case, if the company is invested in securities, by any chance, if individual security exceeds 50% and control is established, but still being an investment company, it will not consolidate. So, for example, there is a big investment. Say, for example, HDFC has made a fund. That fund has got a lot of money, right? They collected 500 crore of money, right? Out of 500 crore, say they invested 100 crore in company A and acquired 60%. Now, as such, by having 60%, the fund controls company A. But because it's an investment company, it will not do consolidation. The whole objective of an investment company is to make investment, buy and sell investment, make profit. The objective is not to control for a long term. So that's a specific exemption given. But otherwise, in all other circumstances, other than those are listed here, everywhere the consolidation will be applicable. And again, for the last one, for investment entity, there is an example, so which will cover in detail. So there are 2-3 slides on that.
So,
Tata Sons will have to, so if the Tata Sons is investment company, it will not. But in this, Tata Sons is just a holding company. So Tata Sons will have to consolidate.
It's a CIC.
It's a
co-investment.
Yeah, it's a co-investment. The definition of investment is also written under the characteristics. So, basically the objective is it collects money from multiple investors. So if the company is investing, or the company is collecting money from multiple investors, invest for a short term or capital appreciation, then it is exempt. But Tata Sons is basically a holding company. It's not a company with investment objective for benefiting the thousands of investors. So the definition of investment company is also given, and we will cover that. But per se, the Tata Sons will not be applicable. Now, what we have seen is, the benefit trust which are created for employee benefit, for example, gratuity or relocation, are exempted. The question arises, what about ESOP trust? The trusts which are created for share-based payment, whether these are excluded or these are to be consolidated. Now, again, there is no specific exemption under the standard. The standard very clearly says employee benefit schemes for post-retirement and employee benefit, which means provision, the trusts which are created for gratuity or the trusts which are created for PF are excluded. ESOP trust is actually not excluded by default. So if there is a control by the management, then ESOP trust also will need to be consolidated. However, if there is no control, if the company can say, these are purely by the deed of trustees, and we don't have any control, the decisions are taken by the trustees directly, by the management. The management is different. And once we contribute, our share is over. we don't have any continuing relationship with that, then it's a different thing. But most likely, this will get consolidated.
Section 25 company.
Section 25 company, yeah, so if there is a control, then those will have to be consolidated. But unless the deed is very clear that once you contribute, your contribution is over, then there is no relationship, then it's a different thing. If there is a separate trust deed, if there is a separate management, totally different, and we can establish there is no control, then it's a different thing.
Sometimes there are some companies providing their own treasury shares to a trust.
Right.
Now, of course, it's not suppose a discharge is somebody else.
Right.
Those trusts will not
Will not be considered because finally it is within the control of the company.
no, control and its ultimately beneficiary is the company itself.
Right.
Actually, the number of shareholders should go down.
Right. It will go.
So we will control basically as of 31st March now. It will last year
Right. So just wait. There is another one. Spinning. It's a good point, and very well. Why I'm delighted that you raised this because the third point actually addresses that. Right. Consolidation. The second question is: can independent subsidiaries be exempted from consolidation? Right? Can you take a call that you have multiple subsidiaries? Say 500 subsidiaries. Can you avoid consolidation of the immaterial subsidiaries, which are like say 50 subsidiaries are totally immaterial? Answer is no. The standard says very clearly all the companies need to be consolidated. Now there could be gap adjustment which are not material, and you may do away with that, or if there are accounting policies which are different, and you may not be able to align few of the accounting policies. So there is a specific exemption. But as far as consolidation of the subsidiary itself is concerned, there is no exemption. So even if the companies are immaterial, the subsidiaries are immaterial, still the company will have to prepare consolidated financial statement considering all the companies together. The third question which you raised, requirement to prepare consolidated financial statement where the entity disposes of that investment. Suppose, for example, you had a subsidiary company up to say September. You are preparing accounts as of December. So as of December, when you are preparing balance sheet, that subsidiary company no longer exists because you have already disposed of the share. Do you have to prepare consolidated financial statement as of December? Answer is yes. You need to prepare CFS because the control has to be looked throughout the year. It is not at any point of time. You have to look at the picture for 365 days, or if it's a shorter period, for that shorter period, but for the full period. So if there is a control, even for few days, you need to prepare CFS for those many days, because control up to the time the control was existing, till that time you will consolidate it. So if the control was there up to September, you will consolidate results up to September based on the September balance sheet. Based on the carrying value of September, you will see what is the gain or loss on disposal. Right? So suppose your investment you made say on 1st of January. Now you acquired that subsidiary company at say 1,000 rupees. Now the same 1,000 rupee company after investment you continued for say 9 months. On 30th September you disposed of that subsidiary company at say 1,200, right? And then when you are making December financial, how will you consolidate? So you will consolidate results up to 9 months from January to September. Now you have acquired the company 1,000 rupees. You are selling it 1,200, right? So gain is 200, but technically that is not the gain. The gain is it should be the sales realization should be compared to the carrying value as on 30th September. So suppose if you have made profit of say 100 during 9 months, so that 100 rupees of profit gets added to the investment value, and the profit earned on sale of subsidiary is only 100. The remaining 100, 1,200 minus 1,100, and that 100 profit what you earn will be forming part of your operating profit. So you earn 200, but the disclosure gets bifurcated into different line items. 100 rupees, which is business profit, will be added to your business profit of the operations, and the 100 rupees what you make additional is nothing but the gain on the sale of subsidiary. Yeah. Did I answer?
But does it require as it is the first 9 months, because there was profits in the subsidiary, line by line or as you consolidate the profit will in any case get to that. So obviously you again cannot book the 200.
Right.
The balance 200 is on the capital account.
Right.
So
yeah.
investments.
Right. What you are saying is right. So total profit is 200, out of which 100 rupees will get booked when you do consolidation, and the remaining 100 which is 1200 minus
So if you had
1100.
prepared a balance sheet as of September, in any case, the 100 would have got accounted.
Perfect.
And the investor gets 1100, the balance 100 gets monthly.
Perfect.
Say, what is, if I say, in the month of November, do I have to see till October balance sheet? How will I?
So technically it's up to the day of sale. So for example, if you are selling on say 7th of November, you have to ideally prepare balance sheet of 7th of November. But for our practical purpose, then based on materiality or based on these calls are taken. So you may choose 31st October, being practical and in order to ensure the books are properly closed. Because the companies, even the multinational companies, don't prepare books every day. So there are auto entries, for provisioning. There are auto entries for provision reversal. But those auto entries are also passed on a monthly basis. So at times it is very difficult to prepare balance sheet as of the same day of purchase or sale.
Typically, if you have any FFP and you are
Right. But technically, to answer only technically, it has to be exactly on the day of sale. But I mean, if there are no material items or material transaction, you can take the convenient date which is very near to it. So, yeah, right. So in December, since the subsidiary is not there, there will be no line by line consideration. The profit gets booked by once the carrying value goes up, and the second thing, the realization profit goes up.
What does this mean is it's no longer subsidiary not because of sale, but because of the infusion by somebody else
Okay.
at a premium, so that it's a become 30%.
Right.
Cost and 50%.
Right. So as far as the standard is concerned, whether you save your share and lose control, or because of some other reason you lose control, there is no difference. Once you lose the control, you need to pass the entries for recording the value of losing the control. So you may sell the share and it may not be a subsidiary, or the other company has invested, or the investor has invested in that company and you lose control. It does not have any difference as far as the standard is concerned. In both the cases, you put the gain.
If the investor is putting money at premium, you will book profit without even realizing profit.
No, so as the investor has invested in your subsidiary company, and because of which you have lost the control, the fact is you have lost the control, and you need to give the gain or loss. Even so it's not a direct disposal, but indirect disposal, because other investor has already put in the money which you have not. Yeah, investment is there. So investment continues, but instead of 60%, for example. Value will be changed. Instead of 60%, now we are holding only 30%. So with 30%, you will have to consolidate.
I will be consolidating. I am not doing any minimum profits.
No, you will have to book that. You will have to book the profit. Once you lose the control, you will have to pass the entry for profit and loss. Right, similar. So for example, you are invested. So at the time of disposal, when your holding comes down from say 51% to say 30%, you will see what is the value on the day of losing the control, and that much gain will come in the profit and loss account. So suppose, I think I have some right now, but suppose in the company you had invested say 1,000 rupees, and the company was say 100% subsidiary, right? And the carrying value is 1,000. Say it was 10 years back. Now, current year, the business has grown, everything has gone up. Today, current year, the other investor comes in. Say, other investor, instead of valuing 1,000, he values the company, let's say 5,000. And it acquires shares. Your holding from 100% goes down to say 20%. Right? So, what you are doing, your value, suppose from 100% it goes down to say 10%. Right? You are only a 10% shareholder. Now, you are invested say, you are invested 1,000 rupees, right? Now, suppose value is 5,000, 10% of that, so total value is say 5,000. Now, you will have 500 of your share. You will compare that with your investment. So, if you had invested 1,000 rupees, your share at a fair value is 500, you will book the loss of 5. Loss of profit, whatever.
So the loss of profit anything.
Yeah, it could be loss of profit.
Loss of profit.
It will be applicable from 55 to 65 also.
Right.
So you may, without loss of control,
Right.
calculate your own share
Right.
and make an adjustment.
Right. Right.
And after it ceases to be a subsidiary, again it has to be fair.
Right. So,
That
so both. So your profit and loss, so your profit or loss for 90% also will be fair value, and your remaining share will also be a fair value.
So the difference between the fair value and the carrying value.
Yeah. Will be in the profit loss for that year.
There will be no separate entry for that fair value.
No. So okay, so again there are examples of disposal also, and when we cover the differences between IND-AS and IGAP, this is a specific slide and I'll cover that. But just to give you an example or give you a summary, in all cases, whether you share the share, sell the share, or where you dispose of the share indirectly by other investing in all the cases you will have to record the gain or loss on sale of investment.
Just giving the same example, if my holding comes down to 25%, in that case also it is my associate.
Right.
So according
In that case also you have to do.
I'm going to take that profit or loss portion of my percentage holding into consideration. So this will be
So that associate accounting will do going forward. But at the time of losing the control, once you lose the control, you have to record the entry of gain and loss at a fair value. And going forward, you apply associate accounting.
What happens if you don't use the control? Say you are coming down from 85 to 65.
Right. So, okay, very good question.